Okay, so welcome to the computer screen and video number 1 of the Introduction to Professional Level Trading, IPLT video series. So what we're going to do here, guys, is look at the differences between professional traders and retail traders. Video 1, Professional Traders versus Retail Traders 101. Let's get started. So what is the objective of this video series? Well, firstly, it's to provide a framework that allows you guys, retail traders, to emulate consistently profitable professional traders so that you can obviously benefit from the same approach. But this brings up some difficulties because retail traders obviously have differences in their lives compared to professional traders. Professional traders do this full-time and they operate on the professional side of the industry. They operate in a different infrastructure. So this objective has to be expanded. If we're going to aim to make retail traders consistently profitable, the framework that we provide, the professional trader framework, has to allow retail traders to utilize the same approach taken by consistently professional traders in their own retail brokerage accounts. Very obviously, professional traders do this full-time and they operate on the pro side of the industry and they operate within a different infrastructure. They are not trading through retail brokerage accounts. So if we as an organization are going to pass on our knowledge as professional traders to retail, the same approach has to be enabled and applied in the retail trading infrastructure, therefore retail brokerage accounts. Also, retail traders have very different lives to professional traders. Professional traders do this full-time. It can be 8 to 9 hours a day. It can be 12, 16 hours a day. It really depends on the professional capacity of the person involved on the pro side. But essentially, it's a full-time job. For retail traders, it isn't. For retail traders, people have their own full-time jobs. They have small businesses. They have other situations going on in their lives. They have family interests. They have hobbies, etc., etc. This leaves a very small amount of time per day or per week for retail traders to concentrate on trading the financial markets. Therefore, any type of framework that retail traders are given not only has to come from the professional side, but it has to be applicable in both the infrastructure and fit into their lives and do this realistically. Okay. So if you're going to do this on a regular basis and trading is not your primary endeavor, a pro trader framework must allow you as a retail trader to implement the processes from the framework on a regular basis, say on a weekly basis, and realistically fit this endeavor into your normal everyday life. So the objective is very clear here, guys. We're going to provide you with a framework that allows you to emulate consistently profitable pro traders, but it has to be applicable. It has to be applicable in the retail brokerage infrastructure, and it has to be applicable realistically to fit into your already busy lives where different priorities exist. But let's understand the landscape first. Really understanding the financial markets and trading landscape is extremely important to get started. You really have to understand how it operates and who operates within it and the differences between individuals within the financial markets. Retail traders really, honestly, globally, totally misunderstand what a professional trader actually is and what they actually do. And there's a multitude of reasons for that. But essentially, the end result has come to this, and it's generally never changed. Retail traders really don't understand what we do, what pro traders do. As a new retail trader, you have to understand that when you are coming into this industry, you've got to be aware that you're joining a very mature and sophisticated industry that is full of very intelligent, very hungry and ruthless individuals, teams, and organizations. This whole idea that you can just read a book on, say, technical analysis that you've bought on Amazon for $20, okay, from a pro trader's point of view, this whole idea that you can do that and then waltz into the financial markets and make consistent big money day trading for income is, quite frankly, very, very laughable. It's amazing that people still think this is a viable route to going into the financial markets and becoming consistently profitable. If you take that route, guys, you do not stand a chance. The financial markets are going to rip you apart, okay? The markets are full of very intelligent, hungry and ruthless individuals, teams, and organizations. If only life were that simple. You just buy a book on Amazon for $20 on technical analysis, and then all of a sudden, you're going to be, within a couple of years, the next big thing in financial markets, because you're going to turn initially $1,000 into a few million, and then you're going to turn that few million into a billion. It doesn't happen, guys, okay? Don't be ridiculous. You've been told a lie. It doesn't work. And this is really important to understand in terms of appreciating and understanding the landscape of financial markets. There are very big differences between professional traders and retail traders, and also retail trader expectations of what they're capable of and the viable route to market and success via consistently profitable trading versus what a professional trader expects and their route that they take to consistently profitable trading. It's very important to understand this, guys, in order to understand the landscape. If you've been told that it's possible, to read just a few books on technical analysis and maybe some basic fundamental analysis, whatever. If you've been told this is how professional traders approach the markets and that it's completely normal and realistic to expect that you can do that and then go into the financial markets and make money, unfortunately, you've been totally lied to. Professional traders look at this situation and we think it is absolutely ridiculous, okay? Because we see the evidence. The evidence is staring you right in front of your face. The vast majority of retail traders that seek to make regular short-term gains from financial markets, so like day traders, absolutely always blow up. And that's been going on for decades. It's been going on for generations. The evidence is right in front of you. Understand the landscape. It's very, very important. There are big differences between professional traders and retail traders. Now, we've mentioned books. So going online, typing in something online, looking for a way to trade, looking for a way to learn how to trade, and then coming across some books that are around $20, and they're basically claiming that they can teach you how to trade and potentially become profitable. But in the modern context, there's obviously many other ways that these people get you, okay? That these people redirect you into a retail trading environment, which is totally different to the way professional traders do things. And if we think about the book, guys, it's pretty obvious the motivation behind retail traders and why you do this, okay? Because, like I mentioned, you obviously have the job or the small business. You have family commitments. You have hobbies and interests. There's only so many hours in a day. what you're essentially doing is you're looking for the shortcut. And in the modern era, the shortcut doesn't just come in the form of books, it comes in many different forms. Now, you should be familiar with this screenshot here. A retail trader experience, in many, many cases, the vast majority of cases, starts and looks something like this, okay? You go to Google, you type in learn how to trade, and then a plethora of options pop up on the screen. So if we look at this, learn how to trade stocks, Forex, options, Bitcoin, cryptocurrency, stocks online, shares, etc. The list is endless, okay? What essentially is happening here is you're looking for the shortcut, and there is a multitude of players in the market, in the retail trading infrastructure, that are redirecting you into a bad area of the retail trading infrastructure. Why is that? Well, what's going to happen? You're going to type in learn how to trade into Google or your favorite search engine, whatever. You type it in, and what's going to pop up once you start clicking through? It's going to be a multitude of players in the financial markets that essentially exhibit a conflict of interest. What do we mean by conflict of interest? Well, just try it out. Type into Google, learn how to trade. What you're going to see are, in the vast majority of cases, generally speaking, two types of entities. You're going to see retail brokers, and you're going to see educators that essentially work as the marketing arms of the retail brokers. So, what is the conflict of interest? Well, retail brokers want you to trade. Retail brokers want you to trade volume and essentially pay commission every time you trade, whether that's direct commission or commission through the back door by the sale of order flow. So they're volume based, and there's a conflict of interest. They don't really care if you make money in the end. What they care about is that you trade, and you trade a lot. And then we have the educators. The vast majority of educators are essentially marketing arms of the retail brokers. They get paid by the retail brokers every time someone signs up and opens an account, and or they get paid every time you trade and get a check at the end of the month. So essentially, there's a conflict of interest there too. You type this, learn how to trade, into Google. Unfortunately, guys, that's what you're going to bump into. And unfortunately, this is the experience of many retail traders. It's the experience of the vast majority of retail traders. They go into this ecosystem, whether it's via $20 books on Amazon, whether it's typing into Google, learn how to trade, or something very similar, okay? And you go into the ecosystem and you go round and round in circles forever. And people very, very rarely work it out. Now, think about the statistics in the retail brokerage industry. When you look at retail brokerage statistics and you look at the percentage of traders that make money over time, so retail traders that make money and lose money, the clients of retail brokers. There's famous statistics in the industry that 90% of retail traders lose 90% of their deposited margin within 90 days. We popularized that statistic. It's very, very prevalent globally. Certainly, definitely 100% true outside the US. The statistics are slightly better in the US. That's because there's less leverage, but they're not that much different. Now, this statistic that we put out years ago and popularized the 90-90-90 phenomenon, that when you go online, you'll see has been bastardized, if you like, by a lot of educators out there, where they just pin a number on it and say 90% of retail traders lose money. That's the wrong statistic because it's actually 90-90-90. 90% of retail traders lose 90% of their deposited margin within 90 days. So to say that 90% of retail traders lose money is wrong. That's the wrong statistic. The way you've got to look at this is that, yes, 90% will lose the vast majority of all their money, their deposited margin, within 90 days. But what actually happens after? Do the 10% that don't lose 90% of their deposited margin actually make money? And actually, those 10% within the 90 days, how much did they lose? Well, if we look at a longer term statistic and we say, okay, after 2 years of trading, what percentage of retail traders make money? Well, there's multiple studies out there. It's around 2-3% of retail traders after 2 years are profitable. That means they've been consistently profitable over that period and they're up. They're making some money. But let's think about that statistic and these statistics in the modern era and in the bigger picture. When we look at this image on the screen, the Google search engine, and typing in learn how to trade. Google's been accessible since the early 2000s, so about 20 years. Has the internet actually improved the statistics? We have more information than we have ever had in financial markets delivered to the retail trader and to the general public. Why have the stats not improved? What is the problem here? Well, the problem is that when you go online and type in learn how to trade, you bump into a lot of bad people with conflict of interest, a lot of bad entities with conflict of interest. What they're telling you to do is the total antithesis to what professional traders actually do. And this is why retail traders totally misunderstand what professional traders actually do, because they enter this world via this route or via the $20 book, and they actually genuinely believe that this is how you go about trading financial markets. From a pro trader perspective, it's simply ridiculous because the evidence is staring you right in the face. Again, the vast majority that go this route lose money, and it's not just been happening in the last 10, 20 years. It's been happening for the last 100 years. It's been happening for generations. So regardless of the internet and retail traders having access to more information than ever before in the history of financial markets, despite the internet, the statistics have never changed. Retail traders, in the vast majority, always lose money and lose all of it when they're trading financial markets. Why? Because when you go down this route, the vast majority of the information that you're going to bump into, and when I mean vast majority, I mean close to 100%, okay, is completely useless if your objective is to actually learn how to trade and become a consistently profitable trader. The information is useless. If your objective is to become consistently profitable as a trader, all this information is useless. It's not going to teach you how to become a consistently profitable trader and meet that objective within the retail trading infrastructure, and be able for you to fit this into your life on a weekly basis. This is an experience that we see over and over and over again at the Institute. We see retail traders coming to us, and they've been through this process many times. They come to us because they've been through the process where they've literally gone onto Google and typed in learn how to trade many years ago. We see guys who've been doing this for 5 years, 10 years, 20 years, and they never ever make money. They always fail to make money, and in fact lose most of it or all of it. And then they start realizing when they've been through this experience at some point that it just doesn't work. And a lot of them don't understand the infrastructure and the landscape and as to why it probably doesn't work. Okay. What they're seeing is just the evidence that it doesn't. And they realize I have to go to a genuine professional trader to learn how to do this properly. Now, the way we look at things as pro traders is no different to any other endeavor out there. So whether it's learning how to drive a car, learning a new language, learning how to cook a new recipe, the list is endless. Any learning experience, what it comes down to is the competency hierarchy and the 4 steps of learning. But taking that and applying it to the financial markets and trading and figuring out the landscape and where you operate and how you're going to climb the competency hierarchy. So what you're looking at here is the competency hierarchy, the 4 steps of learning when applied to the trading industry. And essentially the pyramid, the competency hierarchy, the pyramid, breaks down into 2 main areas. So at the bottom, we have unconscious incompetence and conscious incompetence. Therefore, we have 2 areas of incompetence. And then above that, we have conscious competence and unconscious competence. So 2 areas of competency. So let's start right at the very bottom. What have we got here? Well, essentially, that's where the vast majority of market participants, so individuals, exist. This is where the millions and millions and millions of retail traders around the world exist at the level of unconscious incompetence. So what's actually happening here? Well, what we've looked at earlier, where we look at the typical routes in to financial markets for retail traders, where people are typing in to Google, learn how to trade, or buying a book on Amazon for $20. This is the route people are taking, and this is the ecosystem that they end up in. And they end up in the ecosystem of unconscious incompetence. So what is that? Well, if you're typing into Google, learn how to trade, what's happening? You're essentially ending up in that ecosystem where there's players with conflict of interest. So the retail brokers, the educators, they all want you to trade in a certain way, which is to make them get paid and not necessarily you to make money. So you're going into their world. You're operating in the way that they want you to operate, not to become consistently profitable. They couldn't care less. Okay. You're also, bumping into people, and this is the retail brokers and the educators, but also, educators that may look plausible. They may look plausible on the surface, but you're bumping into these people. And what's essentially happening is, because they've never been professional traders themselves, what they're actually doing is, as retail traders themselves, teaching retail traders how to trade. So it's just lunacy. Retail traders teaching retail traders how to trade is lunacy. Okay. Unconscious incompetence is a world, is an ecosystem where the vast majority of retail traders exist. And people just go round and round in circles for years. And the vast majority will actually never even realize it, what's going on. They won't even realize that they're unconsciously incompetent because they've been so sucked in by the marketing that they've become completely delusional. They've been completely sucked in by the narrative and the marketing of the players in the industry that have conflict of interest, the retail brokers and the marketing arms of the retail brokers, the educators that are compensated by them. They've been so sucked into the narrative and the marketing that they've become completely delusional. Okay. So this ecosystem of unconscious incompetence, where the vast majority of retail traders exist, is essentially millions of people globally that really just genuinely have no clue what they're doing. But unfortunately, they think they do. It is a world of total delusion, denial, lies, and total BS. So the question is, how do you actually climb out of the world of unconscious incompetence and climb the competency hierarchy and then become consciously incompetent? So you arrive at the stage of conscious incompetence, and then you actually become, over time, a competent trader. How do you do that? That's the question. Well, the first step here, guys, is pretty obvious, okay? You have to reject everything in the ecosystem that is forced down the throats of retail traders who all become unconsciously incompetent. You have to reject the world of the delusion, the denial, the lies, and the BS, okay? Only then can you actually stand any chance of rising out of it. But you need the right information. So to rise to the level of conscious incompetence, you need to get hold of the right information. When you've got the right information and you've seen it, okay, at least then you know that you're doing it wrong and there's an alternative, okay? If you've got the right information, that's going to allow you to enable your learning and application. Now, the total industry, the trading industry, is what you're looking at right now. Retail traders are at the bottom, okay, in the level of unconscious incompetence. It happens in stages, okay? Right at the top, you can see individuals in the markets that will be defined as unconsciously competent, okay? That's where professional traders exist. They exist, we exist at the top of the pyramid. We've been doing it for years, decades, and we are consistently profitable. To get to that stage, you can't just jump there, okay? There's no shortcut, there's no hack, okay? You have to get the right information and you have to learn it and then apply it, okay? So the first stage is getting hold of the information, rejecting unconscious incompetence, and becoming consciously incompetent. So you've got the right information, you know you're doing it wrong, and that's going to enable your learning and application. So the first step is simply admitting, it's an admission, okay, that everything you've been doing in the past, everything you've been doing that hasn't worked in financial markets as a retail trader operating at the unconscious incompetent level does not work. And then seeking out the right information and then learning it. That's what's going to get you into conscious incompetence, okay? Now, because you're here, just being here, you know, taking the IPLT video series, even moving on to complete other programs like the PTM video series, POTM video series, the FTM video series at ITPM. What's that going to do for you? Well, just being here means you're on your journey. And it can be a long road, which we'll get into in a moment, okay? But the first step to get from unconscious incompetence into conscious incompetence is an admission and an acknowledgement that it's going to take some effort, okay? To be at conscious incompetence, you've got the right information and you've got to learn it, okay? Learning the theory, learning the information, and then you will be solidly in the block of the pyramid that we would call conscious incompetence. So the information itself is what ITPM provides, okay, in the form of our video programs. You take them, you learn them, you take the exams, you come out of it definitely as a consciously incompetent retail trader, okay? But that's progress. You've moved from the bottom of the pyramid, okay? What's next? Well, you're moving into conscious competence. This is where you're moving from being incompetent to actually being competent. Okay. What does that involve? Well, there's no shortcuts. There's no hack. You absolutely have to apply your knowledge with real money and become somewhat profitable and somewhat competent. Okay. You don't have to become amazing overnight. You just want to be doing it for a period of time where you can prove to yourself and prove to any third party coming from the outside and looking at your results, looking at your statistics. You want to be proving that you are competent. Okay. Competency only comes in the financial markets and trading. Fortunately or unfortunately, whatever way you look at it, it doesn't matter because the numbers don't care. Okay. The only way you're going to get competent is to apply this with real money, get the statistics, and prove to yourself and others that you can do it. Okay. Now, people will ask very obviously, how long does it take to become consciously competent? Well, you can learn the theory, learn the information, learn the right information, and become consciously incompetent within 3 months. You can do that. You can digest the information. You need to be trading for at least a year. The minimum is, say, 9-12 months. So it can be done where you learn the right information and become consciously competent within 1 year. Okay. You can get there. At this stage of conscious competence, you know how to do it right, but you obviously need to keep implementing and get real world practice and experience with real money. That's very important, with real money. Okay. Because essentially this game, the financial markets and trading, it has to be done with real money. Okay. That's how you're going to become competent. So going from incompetence to competence really involves a period of time of application and a certain number of trades. We can get into that later in the video series, but in terms of time, you're looking at your first year in financial markets. Now, what happens if you're 9-12 months into your trading journey? You're trying to become competent at trading, but you're struggling. You're struggling to turn the theory and the knowledge, so the information, the right information that you managed to get hold of 9 to 12 months previously. What happens at this stage if you're struggling? Well, you've got the right information, you've got the right knowledge. You're just probably having some problems implementing over time, over a certain amount of trades, and you're probably making some mistakes. At that stage, what you're probably best doing, and it'd be well advised to do it, or even earlier, if you want a bit of a shortcut to success, would actually be to do a mentoring program with a professional trader. And ITPM have plenty of professional trading mentors that can help you in that respect. Of course, you can keep going and keep going until you get it. That's not a problem. That's always an option for everybody. And we don't mind people choosing either route. It's totally fine. But if you are struggling at the competency level, becoming consciously competent, a mentoring program with a pro trader would be well advised. Now, what happens if you are consciously competent? So you've got the right information, you've been applying it well, you've started to get some consistency, and now you're actually quite competent as a retail trader. Okay, what's happening here? Well, you're now trying to move into the next phase, which is unconscious competence. What does that really mean? It means you've been doing it long enough and over a long enough amount of trades where it starts to become like an autopilot situation. So what we mean by that is you've done it on repeat so many times that it's becoming second nature. So you can essentially do it right by applying the knowledge, and you're making money consistently without even thinking about it too much. Okay. It's become second nature. Now, what does that mean for retail traders? Well, as stated earlier, we're not just looking at the retail trading infrastructure here. We're looking at the entire trading industry. And at the bottom, we've got retail traders. And at the top, we've got professional traders. But as a retail trader, you're not going to be defined as a professional trader in name. Professional traders are licensed and trade other people's money, whether it's at an investment bank or a hedge fund. Investment bank traders essentially trade the shareholders' money. Hedge fund traders, they trade investor money. Okay. So as a retail trader, you're not going to be licensed. You're not going to be what we term, open quotes, professional traders, close quotes. But what you are going to be is as competent as they are. So within the retail trading infrastructure, if you're operating at unconscious competence at that level, you're still a retail trader operating in the retail trading infrastructure, but you're implementing successfully on autopilot, on repeat, everything that professional traders do, and you're getting the statistics or even better statistics than professional traders themselves. So you would be located in that block at the top as unconsciously competent because you're doing everything that professional traders do and you're applying it on autopilot. It's second nature and you've picked up the skill and now you can do it consistently forever. So interestingly as well, we also have on the screen, on the chart here, where institute traders are located. So guys that have taken our online programs, they've taken their exams and they've come into ITPM, they've opened their brokerage accounts, they've deposited money and they've traded, okay, with real money. Institute traders, obviously, we've had institute traders that have been around for a long time, for many years, and we've got institute traders that are just starting out. So this is why when you look on the chart here, you can see institute traders are located exactly equidistant between conscious competence and unconscious competence. What does that actually mean? Well, they're definitely not at the bottom. They're not retail traders that are unconsciously incompetent. They've rejected that world. They've grown up. They've woken up and they've come into the institute to learn the right information. So they learn it in a period of 1 month, 2 months, 3 months, however long it takes them due to their own personal circumstances. They pass their exams and then they open their trading account and they jump into conscious competence after a certain amount of time and a certain amount of trades. Okay. And then over time, they climb the competency hierarchy into unconscious competence, where after year 1, they can start to say when they're in their second year, and definitely at the end of their second year, they can say they've become unconsciously competent. So that's where our retail traders exist. The institute traders at ITPM, they exist somewhere between conscious competence and unconscious competence, but definitely in the competency area. And it really just depends on the amount of time they've been around, the amount of time they've been applying it, and the amount of trades that they've applied it across. Because essentially, guys, you have to get the statistics. And obviously, the more trades you do, the more statistically significant your performance becomes. So when we're looking at our potential journey here, guys, over the next 1 to 2 years, and we're looking at the top of the competency hierarchy at professional traders, and we're seeking to emulate them in the retail brokerage infrastructure, okay? If we're looking at the total hierarchy here and saying, how the hell are we going to get there? Well, let's work backwards. We have to begin by really understanding what professional traders actually do. So first of all, what we really have to do before we even attempt to emulate professional traders, you have to define what a professional trader actually is and what they do, okay? Only then can you start to make your way up the competency hierarchy through both education and real world, real money implementation. It is absolutely impossible, guys, to climb out of unconscious incompetency unless you understand what a professional trader is and what they actually do. So let's have a look at exactly what a professional trader is. But let's put this into context first. I hope you didn't forget what our objective is here. It's to provide a framework that allows retail traders to emulate consistently profitable professional traders so you can benefit from the same approach. Therefore, we have to define exactly what a professional trader is. Our main objective here is to emulate them in the retail brokerage infrastructure. So we've got to know what they do. Okay, guys? What is the definition? Well, to put it simply, a professional trader is a full-time trader that works at either an investment bank or a hedge fund. That is the case in the vast majority, okay? Of course, there will be some minor exceptions to the rule. We're not here to deal with minor exceptions. We're here to solve a major, big problem in the world, which is to get retail traders competent at trading, therefore emulating professional traders in the majority. In the majority of cases, a professional trader is defined as a full-time trader that works at either an investment bank or a hedge fund. Okay? So we've got to answer 4 major questions to understand this and stand a chance, take the first step in getting out of unconscious incompetence. First question that we have to answer: what does a professional trader at an investment bank actually do? Second question: what does a professional trader at a hedge fund actually do? Question 3: what does this actually mean for retail traders? And question 4: what are the differences between the two, between professional traders and retail traders? And when we know that, we can start to climb out of unconscious incompetence and bridge the gap between the two. So these are the questions that we have to answer in order to provide a foundation for you to build on that foundation and to climb the competency hierarchy. So let's get started by posing the question: what does a professional trader at an investment bank actually do? Well, in the past, there were 2 functions of a trader at an investment bank. And I need some attention to detail from you here, guys. Please try to focus on exactly what I'm saying here and be specific and understand that we're using the word past here, okay? So a bit of attention to detail. We're looking at the past and the present, okay? In the past, traders at investment banks would have 2 trading accounts and 2 functions, okay? The first function was as market makers, okay? And the second function was as proprietary traders, so sometimes called prop trading, okay? And all traders in investment banks would have 2 accounts. Let's have a look at market making in the modern context, okay? So market making, what is it? Well, it's essentially clients of the firm, clients of the bank, coming into the bank and dealing with the bank, either directly on risk or as agent. We'll come into the differences of those soon. But essentially these days, 100% of traders and 100% of a trader's time at an investment bank is spent doing market making activity. So it's spent on generating business with clients, which are mainly hedge funds and pension funds. And they're making markets, these traders. So market making, they are making markets in assets like stocks, currencies, commodities and bonds to those clients. Okay. Now, of course, within an investment bank, there's divisions. Okay. There's the equities division, which is stocks. So equities are stocks. There's the currencies division. There's the commodities division. There's the bonds division. Okay. The same traders are not trading all the same asset classes. Okay. There's different traders in different divisions. So the vast majority, okay, of the time, 100%, close to 100% or even 100% of a trader's time at an investment bank right now is spent on market making activity. So generating business with hedge funds and pension funds and making markets in different asset classes to those clients. In the past, in the old days, there was also proprietary trading, so prop trading. Investment bank traders in the old days used to spend a large amount of their time using the bank's balance sheet, so the funds that they're given on account, trying to make money for the bank by trading the money proprietarily, by prop trading. Now, the true definition of what prop trading actually is all trading that the trader does that is proprietary to executing client business. So market making activity is executing client business. Proprietary trading is taking the bank's money that they've allocated to you, going into the financial markets and using that money to make money. Okay. That is prop trading, and proprietary trading is everything that's proprietary to market making activity. This was the setup in the old days, in the past, before something changed in the industry. So in the past, every investment bank trader used to have two trading accounts, a market making account and a proprietary trading account. This, unfortunately, no longer exists at investment banks due to the Volcker Rule, which went into full effect from April 1st, 2014. And banks had to become, they had no choice. Banks had to become fully compliant by July 21st, 2015. But in reality, after the financial crisis of 2008-2009, the Volcker Rule was not fully implemented, but banks were preparing for it. Around 2010, 2011, that's basically when the banks started preparing for the Volcker Rule and proprietary trading activity ceased to exist in the industry. Now, despite the Volcker Rule, investment banks are still allowed to continue market making activities and hedging activities, and obviously agency business as well. This business is still around, okay? Of course, with market making activities, banks, when they're making prices to clients like hedge funds and pension funds, there will be situations where they have to commit capital and they will have to provide liquidity to the hedge funds and pension funds. That requires the capability of actually being able to hedge positions if required. And the agency business, which we'll come on to in a moment, is probably always going to exist, okay? But investment banks can also trade government securities like government-issued bonds. That is a necessary infrastructure for liquidity in the sovereign bond market. So investment banks can still get involved in all of those activities. The big change, the Volcker Rule, basically eliminated proprietary trading for the traders at investment banks. In the past, guys, investment bank traders had 2 trading accounts, market making and proprietary trading. But now prop trading is gone and they only have 1 account. As mentioned, the Volcker rule, which was implemented in 2014, and banks had to become fully compliant in 2015. The Volcker rule was actually designed in 2010 and then slowly implemented by the investment banks before it was compulsory in 2015. So what was happening? After the global financial crisis, the Volcker rule was designed eliminating proprietary trading at investment banks by a certain date in the future. So implemented 2014, compulsory by 2015. But in reality, the banks slowly unwound their dependence on proprietary trading activities because they needed time to do so. So it was designed in 2010 and it took them 5 years to unwind their dependency on proprietary trading. So it's vitally important, guys, to understand the landscape here of what's happened in the past and what the industry looks like now. Because if we're going to really understand what professional traders do, well, professional traders have been operating at investment banks for a long time. So we have to understand what's happened to professional traders at investment banks in the past and what's happening to them in the present. Because if we're really going to understand what professional traders do, it's important to know that, okay? To know how the industry is set up, to know how the landscape is set up, and to know what these guys actually did in the past and what they do now. So, as mentioned, the market making activity that professional traders at investment banks engage in now, it's essentially now the bread and butter business of the investment bank trader, because there is no proprietary trading anymore. And we're going to learn about the market making activity, because it's important to know this and to understand the context of what a modern professional trader is. So we can understand from a retail trading perspective what elements we can take from the professional world and implement into our own world, into the retail trading infrastructure. Now, market making splits up into 2 categories. There's agency business and risk business. So the first category, agency business, that involves the investment bank not taking on any risk to the client. So if you recall, the typical clients of investment banks are hedge funds and pension funds. We'll come to agency business in a second and have a look at the definition there. The second category is risk business, where the investment bank is essentially taking on risk to the client. We're going to be having a look at the definition of that too. So it's important to understand this stuff, guys, because really understanding what a professional trader does is going to help us effectively navigate the retail trading landscape in emulating professional traders. So let's have a look at market making category number 1, agency business. So what happens at an investment bank these days when the phone rings and there's a hedge fund or a pension fund on the other side of the phone, and they want to, for example, buy some stock via the investment bank? Well, they've got 2 choices. They can give the investment bank an agency order, or they can ask the trader to make a price, which in the market making activity, if they're making a price, they are going on risk. If they are simply given an order to execute in the market, the investment bank is essentially acting as agent. So what are they actually doing? Well, they're picking up the phone to the hedge fund or the pension fund. That client is giving them an order to act as agent with no risk to the investment bank in order to buy or sell stock in the financial markets. So what happens here? Well, a commission is charged on all market making business. So that's agency and risk business. A commission is charged by the investment bank to the client. Typically these days, you're looking at 3 basis points. Now, of course, there will be different charges for different situations, but the blended average works out these days to be around 3 basis points, which is very, very low. Pre-global financial crisis, there were some pension funds in the world still paying 20, 30 basis points on even agency business to the investment bank. Over time, that's just been crushed because of technology. These days, you don't even have to need a human to do this. Okay, in the old days, a human would execute this order over a period of time. They would execute agency business over a period of time. These days, it's pretty much done by algorithms, software, and a computer. Now, in terms of the agency business and risk business split, typically agency business makes up about 80% of all market making business. This is the predominant way investment banks trade orders in the financial markets these days. Let's have a look at a quick example. Let's have a look at an example in Apple where a hedge fund, say, calls up one of the investment banks, Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, whoever, doesn't really matter. So in the example, hedge fund calls up one of the investment banks, and wants to buy $10 million worth of Apple stock at $120 a share. So that works out to be 83,333 Apple. The commission to the bank on this would work out to be $3,000. So in the interests of learning some vernacular from the financial markets, everyone talks in basis points. The commission here is 3 basis points. 100 basis points equals 1%. So 1 basis point equals 0.01%. Remember, this situation to the bank is totally risk-free. And these days, everything that is agency business is input into a computer algorithm, and it just executes according to the client's instructions. So what's the investment bank doing here? They're basically doing nothing. Let's cut to the chase. They're doing nothing. They're not really doing anything here. They're just picking up the phone, taking the order, putting it into an algorithm, and the algorithm executes it. And the client, the hedge fund, gets their execution when it's done, when they are filled. That is the agency business in a nutshell. So that's the agency business, guys. It's very straightforward, very simple in terms of business execution. Where it gets a bit more complicated is on the risk side of the business. So this is slightly different. And we can take the example that we looked at on the previous slide to understand the risk business. The risk business typically makes up about 20% of all market making business. So it is in the minority of business, whereas agency takes up 80, as we've seen. If we take the previous example, what actually happens here is instead of the client, so the hedge fund, coming to the bank and just giving the bank an order to process in the market and paying a commission to the bank for doing that, what happens on the risk side of market making is that the pension fund or hedge fund goes to the bank and asks the bank to commit capital to the trade. So in this example, the Apple example, where the client is basically looking to purchase $10 million worth of Apple stock at $120. so the 83,333 shares, what happens is that the trader at the investment bank commits the bank's balance sheet, commits capital, and actually ends up shorting $10 million worth of Apple at $120. So the 83,333 shares. The trader ends up shorting that on their book to the client, to the hedge fund or the pension fund. So now that the client is long the stock and the trader at the investment bank is short, what has to happen? Well, the client's happy at this stage. What has to happen is the trader has to buy back the short in the market to square their exposure, to get flat. Now, if they buy them back above $120, they're going to lose money. If they buy them back below $120, they're going to make money. So the profit and loss for the trader at an investment bank when engaging in market making activity on the risk side of the business, the profit or loss is worked out by taking the total sum of the commission earned and the money that's made or lost when actually closing the risk position that the trader has taken on the client trade. So let's run through some numbers here where we look at our example in both a loss-making situation and a profit-making situation. So let's say, for example, in the loss scenario, the trader buys back all of the 83,333 Apple shares at 25 cents above where they've shorted them. So they shorted them to the client at $120. Let's look at a scenario where the trader covers the short at $120.25. But in the process, the bank does obviously make the $3,000 commission from the trade. However, it does work out actually to be a negative. So the trader loses $17,833.25. In the industry, this is called negative retention. Why? Because the commission paid, the $3,000, has not been retained. The trader has lost money in total on the position and on the total trade, including the commission. Now, if we look at the profit example, essentially it's the opposite of that. It's positive retention. The trader's keeping all the commission. Okay. So if the trader buys back all of the 83,333 shares of Apple at, let's say, $119.56, what's happening here? Well, the trader's making 44 cents on the stock, so the 83,033 shares. So they're making $36,666.52. But remember, the banks also earned the $3,000 commission. So in total, the bank, the trader, has made $39,666.52. That is essentially positive retention because the trader has kept all of the commission and a bonus, made a profit on the actual position that they've taken on the other side of the client trade. Now, this metric of retention, it's very, very important in the world of investment banking because it's essentially a trader who's working at an investment bank. It's essentially the way they are measured. The ability of a market maker is generally measured by the amount of percentage of the commission retained by the trader. So in the positive example that we looked at, the trader's retention is 100% and negative 100% in the negative example. Now, when you look at, for example, the market making business on a trading desk, it's obviously huge. It's not, one or two trades a day. I mean, there's tens of thousands, hundreds of thousands, if not millions of trades a year. Okay. Generally speaking, over tens of thousands of trades a year, over an infinite amount of trades, over a certain period of time, a good normal retention
is around 70%. That's what's considered a good blended average rate for a trader. Okay. That's pretty normal. That's a pretty standard situation. Now, the way these risk trades are actually unwound now, in the old days, the trader's discretion was used. Traders used to go into the market and take the view that, if they shorted $10 million of Apple to a client at a certain price, then they could make a decision on whether they think Apple is going to go down or up over the next hour, over the morning, over the afternoon, over the day, over the next few days. In the old days, it was done on a discretionary basis. In the mid-2000s, it really shifted. It started to shift into a scenario whereby algorithms were introduced, and the risk unwind of a position when a trader was taking the other side of a client trade, the risk unwind order was be put into an algorithm. And nowadays, pretty much all of the unwind of a risk unwind is put into an algorithm, similar to the way the agency business that we discussed earlier is executed. And in reality, what actually happens on a trading desk is the traders at any one time on a given day, they're making prices on a risk basis quite frequently. So, every 15 to 30 minutes, traders will be making a price to clients on a risk basis and taking the other side. So it's a lot easier if you think about it from the business's perspective, from a shareholder's perspective, from a management perspective. It's a lot easier if you can downsize your entire trading operation and outsource the unwind to a machine. Obviously, we looked at that Apple position. That's one example of what would be done very realistically on a trading desk. But that wouldn't be the only position. There'd be hundreds of positions at any one time. Okay. What do hundreds of positions, when you add them all up, naturally become? They become a portfolio. Okay. And in the old investment banking model, so pre-Volcker rule, all of these positions, when you added them all up together as a portfolio, they were categorized by the bank as a negative selection portfolio. So what is that? What is a negative selection portfolio? Well, if you think about a bunch of traders on a desk having to make prices all the time to clients, and the clients at the other side is taking the other side, and the client is basically coming in and surprising them. Well, it means that all of those traders and all of those positions added up together, they don't necessarily want those positions. They don't necessarily have a view on those positions. What they're actually doing is they're just processing inventory. They're processing customer risk business in order to make the formula we discussed on the previous page, which is to make the total sum of commission earned with a retention ratio that's respectable, so around 70%. So they keep 70% of that money coming through the door, and they don't necessarily have a view on any of the positions that they're taking. That is essentially the definition of a negative selection portfolio. In reality, these days, the vast majority of a professional trader's time at an investment bank is not actually spent taking positions and trading positions that they want to have. They are negative selection positions, and all combined, those positions make up what's termed in the industry as a negative selection portfolio. The vast majority of a trader's time at an investment bank is spent processing execution orders and unwinding risk managed by algorithms. So what are traders actually doing? 20% of the time, they're occasionally making prices to clients and taking the other side. But even the risk business these days is unwound by an algorithm. And the other 80% of the time, it's watching over the algorithms performing agency execution. So 100% of the time, guys, 100% of the time these days, pretty much at an investment bank, a trader's job is to oversee algorithms. So what are they doing? They're doing the agency business 80% of the time, and 20% of the time overseeing and trading negative selection portfolios. So getting out of positions that they don't actually want to have or have a view on. Now, as outlined earlier, pre the Volcker rule, professional traders at investment banks had 2 trading accounts. So market making and proprietary trading accounts. Now they only have 1 account. Proprietary trading has been curbed massively. It's gone upstairs to the management level, and it's in the hands of very, very few people. Okay. On a side note, this is why the best investment bank traders left the industry around the time of the global financial crisis or within a few years after the global financial crisis. Why? Because from their own career perspective, their skills as a proprietary trader would no longer be monetized. So if you were a skillful trader at an investment bank, meaning that you were a skillful proprietary trader at an investment bank, you left the industry, because that's how people were paid in the previous business cycle, pre the global financial crisis, and going back at least 30 years in the industry before that. People were paid their bonuses based on their ability to make money as a proprietary trader. So what does this mean for retail traders? What can retail traders actually learn from all this? And, we've been building up to this, and this is why it's important in terms of understanding of how the industry works and in emulating professional traders to climb the competency hierarchy. If retail traders are seeking to emulate professional traders at an investment bank, they must not attempt to emulate the pro trader when they're functioning as a market maker. Okay? It is simply irrelevant. Completely irrelevant. Why? Well, we've just discussed negative selection portfolios. Okay? We'll get onto that again in a second. The function of a trader at an investment bank that a retail trader has to try and emulate is the proprietary trading function that was pre-Volcker rule. Okay? Investment bank traders that traded in account number 2, the prop trading account, the proprietary trading account. That is the function that retail traders need to try and emulate from, open quotes, investment bank, close quote, traders. Okay. Now, this looks very, very different to what retail traders expect it to be. I was at investment banks from 2000 to 2007, and I performed both functions. I was both a market maker and a prop trader. I was one of those guys that had the 2 accounts. There was around 30 guys on the equities trading desk in London trading pan-European equities, and I was one of those guys. Now, as discussed, proprietary trading post-Volcker rule no longer exists. Before that, our proprietary trading accounts were huge, and we ran them as long-short portfolios with a 1 to 3 month time horizon in a, open quotes, normal, close quotes, volatility environment. Only in very volatile markets would we switch to being much shorter term traders of, say, within 1 day or overnight or 1 week. And overall, the proprietary trading account, the proprietary trading function, pre-Volcker rule, made up a huge part of our overall activity. It is how we were paid our bonuses. We used to get a cut of the proprietary trading book. So the profit that we made in the proprietary trading book, we would get a cut of it. It was a discretionary bonus, so there was no hard payout, but typically would expect to be paid somewhere between 2 and 4% of what you made in the proprietary trading book. Something like this. It also depended on a number of other factors, which we won't go into here, but essentially a lot of soft factors. So how you're perceived in the firm, how you get involved in firm activities outside of trading, etc. But what's important here is to understand, as a retail trader looking to emulate professional traders at investment banks, first of all, forget about market making activity. It's completely irrelevant. The guys that you have to try and emulate are the pre-Volcker proprietary traders at investment banks who during that time were getting paid very good bonuses because they were making a lot of money in their proprietary trading accounts, because that's how they were paid their bonuses. Okay. Proprietary trading was the biggest function of the book in the early to mid 2000s. Okay. The rest of the business outside prop trading was agency and risk market making. And that provided cash flow to the business. What does that mean? It means there's money coming in every minute, every second, and that cash flow for commission purposes and retention purposes paid for the fixed costs of doing the business. So, main costs, all of the infrastructure, everything that needs to be paid for someone to just be sitting in the seat. That's millions of dollars per head, okay? And of course, on top of that, very important, and we'll come back to this later, the trader's basic salary. That's very important. Remember that. Commission at investment banks and the commission business paid for the infrastructure and the trader's basic salary. It's very important for retail to understand this. The reason in the bigger picture to understand this and why it's so important is because from a retail trader's perspective, when a retail trader is trading and they decide to do trading full time, what has to happen? They have to give up their day job. And when they give up their day job, they give up their salary. Okay? There's so many myths around this that you can go into the market and make an income from trading. You can't. Investment banks and investment bank prop traders literally prove this. Why? Because even at the top professional level, pre-Volcker rule, at investment banks, with highly talented proprietary traders trading the second account, the proprietary trading account, they didn't make the assumption that they were going to make money every year, every month, every day, whatever, on a monthly basis, okay? The way the business works is the commission business, the retention business of the commission pays for all the basic salaries of the professional traders and the infrastructure costs. Pre-Volcker rule, if the trader made no money proprietary trading or even lost money proprietary trading, that trader would receive no bonus. They wouldn't receive any bonus, but they would get still their basic salary. Okay? The significance of this will become apparent for retail traders. Obviously, retail traders, we're trying to help retail traders here. The significance of this will become apparent later in this video and in the video series. So that covers pretty much the function of professional traders at investment banks and how it's changed over the last decade and what retail traders can take from it. Now let's move on to our other category of professional trader, the professional trader at a hedge fund. So what does a professional trader at a hedge fund actually do? Well, the function of a pro trader at a hedge fund, first and foremost, is to protect the capital of their clients. And their clients are their investors, the investors in the funds. The job of the pro trader's function at the hedge fund is to protect the capital of those clients, the investors, in both rising and falling markets. So irrelevant what the market does. That's what's supposed to happen in the vast majority of cases. Okay. Professional traders at hedge funds are also commonly known as portfolio managers or PMs. Okay. We're going to be obviously introducing you to a lot of vernacular, as we have done up to this point. A lot of vernacular in the financial markets. So it's important to get your head around this. Also, just on a side note here, it's very important, obviously, to get attention to detail in financial markets. You know, as you're climbing that competency hierarchy, you will notice when you start looking back to what you were and what you've become, you will notice that your attention to detail has become far greater than it used to be. In the context of video 1, the attention to detail that you need really is to really understand the nuances, the differences between retail and professional, and the differences of different categories of professional, and what you can glean from that information in order to start your journey going from unconscious incompetence and climbing the hierarchy, the competency hierarchy. The difference between investment bank professional traders and hedge fund professional traders, there are nuances. And this is what we're going to discuss now as we build out our understanding of what professional traders at hedge funds are. And one of the main differences here is that when we look at hedge fund traders or portfolio managers, PMs, and compare them to investment bank professional traders who used to trade the prop books, okay, the difference is, remember, the guys at investment banks who traded the prop books were also market makers, okay? This is pre the Volcker rule, okay? The difference is that investment bank traders traded portfolios that they didn't want to have, negative selection,
and portfolios with positions that they did want to have, so positive selection portfolios. The present investment bank trader
doesn't trade a positive selection portfolio because there's no proprietary trading accounts anymore. The present investment bank trader is simply a market maker, both agency and risk. What do they trade? They trade a negative selection portfolio. The only function of a hedge fund trader, portfolio manager, the only function is to trade a positive selection portfolio, to trade positions that they actually want to have. And what do? The vast majority trade long, short portfolios. So hedge fund PMs, unlike the pro traders at investment banks, there's no market making activity. There's no market making activity at hedge funds, the vast majority of them. Hedge fund PMs, typically, when we look at things and we compare hedge fund PMs to investment banks, hedge fund PMs typically have the same function as a proprietary trading function that used to exist for professional traders at investment banks pre the Volcker rule. Now, in terms of professional traders at hedge funds, what they actually do, we have to understand and put it into context when comparing to an investment bank pro trader, the infrastructure. We have to understand the infrastructure differences in order to understand the difference in the traders. Investment bank traders utilize capital provided to them by the bank. But all of these banks are public companies. So the capital is essentially coming from public shareholders. The majority of hedge funds are not public companies. They are private entities that utilize capital provided to them by their private investors, their clients. Okay. Now, we're going to go through a structure of what a typical hedge fund looks like. And yes, there are some hedge funds in the world whose management company is public. Okay. But the fund itself isn't. So this is the money that's held offshore the private investors' clients' money. So let's go through a typical example, but do bear in mind that there are funds out there where a portion or all of their management company is public, but it's only the management company portion. We're not going to say any more about that. It's more important to understand the typical structure, okay? So let's have a look at a typical structure of a hedge fund. Well, they're called hedge funds for a reason, okay? Obviously, the word hedge is very important. We all know what a fund is. They're called hedge funds for a reason. Why? Because they typically have a well-hedged or balanced, diverse, long-short portfolio in one or multiple asset classes. But what is a hedge fund structure? There is an actual definition. And this is very important for retail to understand because it's a very specific definition. There's lots of people out there on the internet that tell you that they run a hedge fund. It's complete nonsense because a hedge fund is a very specific investment vehicle. And typically, and this is about 80% of cases, typically the offshore entity is a Cayman entity that has a prime brokerage agreement with an investment bank. Now, we don't need to really go into what a prime brokerage agreement is or the details of that. Just understand that essentially what happens is that the money is held offshore and never comes onshore. They enter an agreement with the prime brokerage agreement with the investment bank, and the investment bank collateralizes the offshore funds to enable the hedge fund to trade through the bank onshore. And then there's a management company, which is the onshore entity. So how does this work in terms of economics with the hedge fund? Well,
the onshore management company charges an annual fee to the offshore fund.
And the fund itself, which is offshore, essentially invoices an annual performance fee on any profits that they make to the investors. So typically about 20%. So the model, that's the 1 and the 2 and the 20, the models are known as a 1 and 20 model and a 2 and 20 model. Now, there is a catch to this. The investors in hedge funds are not stupid. They do a lot of due diligence. They want the best people to trade their money, but they also require those traders, those hedge fund portfolio managers, to work hard for their pay. Okay. Investors in the fund typically these days require that the portfolio managers, the hedge fund PMs, have to initially invest in the fund, the 20% performance fee. They will require that the hedge fund manager, the PM, reinvests typically about 50% of the performance fee back into the fund each year. And listen, it stands to reason, right? If you're going to invest in someone's strategy within a hedge fund structure, if you're going to invest in that strategy within the structure, you want the portfolio manager to be investing in their own strategy alongside you. Okay. This is a very typical situation these days. In the very, very old days of hedge funds, it may have happened that very good managers would be able to get away with taking out all of the performance fee. But these days, it's just not. Investors are a lot more sophisticated these days. They require that they keeps reinvesting into their own strategy alongside the investors and is actually locked up on those investments, which means they can't take money out of the fund during a certain amount of time after they've reinvested back into the fund. Now, hedge funds typically, as an entity, and in terms of the talent that's retained at hedge funds as traders, portfolio managers, they are, generally speaking, more sophisticated in their talent and their investment or trading approach than professional traders at investment banks. We've already discussed investment banks and how over the last decade things have changed. Proprietary traders have left investment banks. Okay. What has happened to them? Well, most of them have either gone to hedge funds in the last decade, or they've left the entire industry and they now trade with their own money. Hedge funds are typically more sophisticated than investment banks in terms of their trading processes. Why? It's because they only have one function. It's the positive selection criteria, the positive selection portfolio. Their trade idea and risk management processes are extremely refined, okay? Because they don't have to spend a long time of their day, first of all, running negative selection portfolios. On top of that, obviously they're trading positive selection portfolios, but it's a highly competitive industry. Thousands of hedge funds are all chasing the same investors for capital to put into their entities and their strategies. They have to refine their trade idea and risk management processes to become extremely sophisticated in order to get that capital. So it's a very, very refined process at each fund. If they don't do that, no one is going to invest in them. So let's go through a typical hedge fund example. Let's have a look at a $1 billion hedge fund. Let's see what happens typically at a $1 billion fund. So let's call the hedge fund XYZ. XYZ fund has $1 billion of client investor money offshore, sitting in the Cayman Islands on custody with a prime brokerage agreement with an investment bank and an onshore management company in New York, and they have an office in London. Okay. That's a typical situation. $1 billion under management within that entity. What would they be doing? Well, typically they'd hold around 30 positions and run a long short portfolio. Now, of course, it doesn't have to be 15 positions long and 15 positions short. They shift this around a lot. It can be 20 positions long, plays 10 positions short, which gives them a long bias. Or it could be 10 positions long and 20 positions short, which gives them a short bias. In that situation, it can change a lot, right? And this is a typical scenario. It really just depends on the view of the managers, how they want to construct their portfolio, situational to the moment they're in. Okay. It can be 18 plays 12, 12 plays 18. Of course, they have risk management metrics, but let's just go with 30 positions for the moment. Now, in this example, each of the 30 positions would be 3.3% of assets under management, AUM, or because this is the maximum positions they would take, or the minimum percentage position size, they may have less positions. But if they have less positions, they may have a self-imposed position limit of, say, 5% on any one position at any one time. So this is a kind of typical situation that you would see 20 to 33 positions, sorry, 20 to 30 positions, something like this. It's a regular situation. Now let's run with the 3.3 position sizing situation for the moment. So no position in the portfolio can be above, on the $1 billion account, $33.3 million in terms of notional value. Very typical situation. That's what we see all the time. Now, what happens if they do well? Let's make an assumption that the hedge fund makes a 20% return on their portfolio, their $1 billion portfolio, in 1 year with a 14% annualized volatility. This is something we're going to come back to later in terms of the volatility versus the return. This is something that's very important, but I just want to introduce it slightly here because this is a typical approach of a hedge fund. But let's say they make the 20% return in 1 year on the $1 billion. So they're making $200 million in profits. Okay. What do they charge for that? Well, let's assume they charge a 2% management fee. So they charge their investors a 2% management fee. On top of that, they're charging the 20% performance fee that we mentioned earlier. So it's 20% of the 200 million. Okay. So they make 20 million in fees, 2% on the billion management fees, plus 20% of the $200 million. So they're charging 20 million in fees and 40 million in performance. Now remember, managers have to put money back in. So 50% of the hedge fund manager's performance fee, that's $20 million, is going to be reinvested in the fund. So what happens here? 40 million leaves the fund, okay, in fees and performance fees. 20 million gets reinvested, okay? So the 40 million, what does that cover? Well, the 20 million in management fees definitely covers infrastructure and basic salaries, but the 20 million in performance fees will cover all of the hedge fund managers at the firm's bonuses and all other ancillary staff. So what happens at the beginning of the following year? Well, the assets under management of the fund, which started out at $1 billion, now has 160 million added to it in the next year. So the following year, the fund is starting out with 1.16 billion. So $1.160 billion. Now, there's some very important messages that retail traders need to take from not just the hedge fund example, but also in combination with pro traders at investment banks. What does it mean for retail traders? Well, the objective here, obviously, with retail traders is to make money trading. And it's to utilize their own capital to do so. In addition to that, it's not just to make money trading, it's to make money trading regardless of the market condition, whether the market goes up or down, okay? We don't just want to make money when the market goes up. We want to make money regardless of the market condition. So, regardless of market direction, up or down, we want to make money. So let's put all this together, okay? What should retail traders take as key messages from this information? Well, let's go through them. Let's have a look. This is a very, very important slide. Make sure you internalize all of this. Very important if you're planning on moving from unconscious incompetence to conscious incompetence. Very important if you intend to climb the hierarchy, the competency hierarchy, that you really understand this, okay? What does it all mean for retail traders if we're trying to emulate professional traders, okay? Let's start with hedge fund managers. Hedge fund managers very obviously use their own money to trade, and they accept outside investor money, okay? They take positions that they actually want to have, positive selection positions, okay? Traders at investment banks do not trade utilizing their own capital. Hedge fund managers use their own money to trade and accept outside investor money. Investment banks don't use their own money to trade, the traders at investment banks. And the prop traders that used to have left. The guys that are left at investment banks, their function post the Volcker rule is to run a commission revenue business. And when they're taking risk, they're taking risks that they don't want to have, okay? There are differences between hedge fund managers and investment bank traders, okay? Secondly, hedge fund managers and traders pre-Volcker at investment banks, so when prop trading, hold diverse long-short portfolios with a 1 to 3 month time frame. What are they doing if they're running long-short portfolios? Well, there's a reason why they run long-short portfolios, okay? They're running them because they aim to make money in both up and down markets. They are what we call in the industry absolute return. The market goes up, make money. The market goes down, make money. Okay. On top of that, many pre-Volcker investment bank traders became hedge fund managers, or they now trade for themselves. Very important to understand that, because many of the hedge fund managers that we're talking about, when we went through the hedge fund manager example, many of those guys are pre-Volcker investment bank traders. Those guys moved from investment banks, many of them, and became hedge fund managers. They took the same approach with them to the hedge fund community, and their processes became more refined. Okay. Now, moving on to the next one. Both hedge fund managers and including both pre and post Volcker investment bank traders, regardless of their performance, get paid a basic salary. This is super important to internalize as a retail trader. Okay. Hedge fund managers pay themselves and their employees a basic salary from the annual management fee. The management fee is literally designed, guys. It's designed, okay, at a hedge fund. It's designed to pay for all of the infrastructure and running costs of the fund on an annual basis, okay? They purposely, with intent, charge a management fee, okay? So they get a basic salary. All of their staff get a basic salary. And remember, investment bank traders get paid a basic salary as well. Very important to internalize that. Next up, performance, okay? And reinvesting. Hedge fund managers invest in their own fund when they're making money. The principle that matters here is that when the fund works and makes money, a performance fee is charged, and by default, the manager is reinvesting back into their own strategy. Okay. When the performance is zero or negative, okay, performance fee, okay, only basic salaries are paid. Therefore, because there's no performance fee and only basic salaries are paid, the hedge fund manager is not reinvesting more money into the fund. That's a very important principle. This will come up later in the video series, okay? Next up, the job of a hedge fund manager and pre-Volcker investment bank prop traders, and including retail traders, is to make money trading whether the market goes up or down. Absolute return, as we mentioned earlier, very, very important. Okay, we've separated this one out to highlight it. This will come up later in the video series as well. But for now, just try to internalize these 5 points, because the behavior of professional traders and the way they set up their business and the way they trade, these are the lessons that we have to take from them if we're going to start to understand how to emulate professional traders properly. Now, by this stage, you obviously should know that, or put two and two together, that when we're comparing the differences between professional traders and retail traders, we have to compare the function of a hedge fund manager and the pre-Volcker prop trader, that function at an investment bank. When we make this comparison, we have to compare those functions to the typical retail trader profile. Again, the objective here of a retail trader is to make money trading, utilizing their own money as their capital base. So it's completely logical. It stands to reason for retail traders to compare the most successful pro traders that utilize their own capital and attempt to emulate their strategies. Okay. Big problem though, as we discussed right at the beginning of the video, okay, when we saw the Google search of the typical retail trader, learn how to trade. Big problem is that there's a huge amount of misinformation in the market, and players in the market that exhibit inherent conflicts of interest, COI, that exist just in the retail trading industry around the world. This creates a massive problem because the vast majority of retail traders simply do not know these strategies. Forget about even trying to implement them. It's just understanding what they actually are, okay? The vast majority of retail traders simply have no clue, okay? And that brings us back to the competency hierarchy, unconscious incompetence. This is why retail traders, the vast majority of retail traders, unfortunately, will sit at the level of unconscious incompetence for their entire lives, because they've got no way of accessing and understanding the strategies of professional traders that are aligned with their own objectives. Fortunately, we're here to give you that. So, let's have a look at, beginning with the approaches in terms of approach, risk, return, and outcome between professional traders. We're building you up. We're trying to form a level of foundation here for an understanding at the level of unconscious incompetence, the differences between professional traders and retail traders. The more we go through this video series, the more competency you're going to pick up, and the more you're going to understand this, and you're going to raise your level of competency. Keep going. If you need to rewind the video, go back, watch things over again, watch things 2 or 3 times if you need to. Very, very important to get this foundation. We're going to get there. Keep going. And try to internalize all of these points that we're making here. Because people who don't simply will sit at the level of unconscious incompetence forever. People who start getting this and start understanding the approach and then moving on to the actual implementation of the strategies that we teach at ITPM will climb the hierarchy. Okay, so let's try and put all of this together and try to obviously take each of these points as they come, try to internalize them, and let's try and climb the hierarchy. So, understanding professional traders versus retail traders, what are the differences in approach, risk, return, and outcome? Well, left-hand side, we've got the hedge fund manager and the old school investment bank professional trader, the pre-Volcker rule IB trader. On the right-hand side, we've got the retail trader, the retail independent or private trader, okay? So let's start with approach. The hedge fund manager and the investment bank pre-Volcker pro trader, their approach is to look at everything in the 1 to 3 month time horizon, okay? They enter positions solely on the basis, okay, regardless of fundamentals, regardless of everything, okay, with the intent to make money in the 1 to 3 month time frame. This approach is totally different to the retail trader approach, which essentially, when you break it down, is very, very short term or day trading. So it's directional day or short term trading. That's a very big difference and very counter to current perception from retail traders in the retail trading industry. Okay. What about in terms of risk? What's the outlook from a hedge fund manager or a pre-Volcker investment bank prop trader? What's the outlook in terms of risk? How do they see risk and how do they generally manage it? Well, for those guys, it's all about diversity and risk management, okay? What do we mean by diversity? Well, we mean that there's not just one or two positions in a portfolio. We mean that there's many positions in a portfolio, so no one position can determine the outcome of your portfolio. And by risk management, we mean that those positions that you have in your portfolio, in your trading account, the risk is managed both preemptively and reactively. We come onto that much later in the video series and other video programs at ITPM. But essentially, preemptive risk management is putting some sort of rules or systems in place, minimums and maximums that are parameters predetermined before you have any positions whatsoever. And reactive risk management is when you already have the positions, preemptive parameters, you already have the positions, and something happens. And those positions either become a winner or a loser or hovering around flat. The reactive risk management function is to do something about it. What is the action you take afterwards? What do you do with a winner? What do you do with a loser? What do you trade? What is your action? Okay. This differs greatly from retail traders, because retail traders, whenever you open up a retail trading account, yes, in the minority of cases, there are some people that have diversity in their trading accounts. Well, at least they think they do. Just having lots of positions doesn't mean you have diversity, okay? Because you could end up with the same risk, meaning that things that happen in the world could affect all of your positions in the same way, okay? So having diversity is not just as simple as having lots of positions, okay? The situation with retail traders tends to be extremely concentrated risk. What we mean by that is simply having one or two positions in the portfolio. And this, generally speaking, comes from a lack of ideas. Retail traders really, a big difference between retail traders and professional traders is that professional traders have a process that generates multiple trade ideas over a given time horizon, and they generally pick the best ones and select the ones that fit nicely into their portfolio as well. Retail traders don't have that process. Retail traders generally get their ideas from mainstream media, the newspaper, blogs online, chat rooms. Basically, they get their ideas when you put it all together. Retail traders generally get their ideas from media that's given to them. And that's the wrong way to go about trading. So what they do is they generally end up with their favorite positions that are given to them via media channels. Professional traders don't do that. Professional traders have a process and they generate their own ideas, and they don't even listen to mainstream media. They don't read newspapers. If they do, they're doing it for some background information. They're not getting their trade ideas from the media or online. They generate their ideas themselves, top down and bottom up. Retail traders, in terms of risk, end up with concentrated risk because they have no ideas of their own. So what do they end up with? Just a few ideas that came via some media channels. And they think that they have an edge. They think that the ideas that they've put on are their ideas when they're not. They've just been given to them. So there's a big difference there. So big difference in approach and a big difference in risk. Okay. And what the risk really comes down to is, even, and this is what we discussed just a few minutes ago with, retail traders that think they have diverse portfolios. They don't, generally. They're in the significant minority, retail traders that have lots of positions. They're in the significant minority. But generally speaking, when you actually look at their portfolios, they end up in all the same stuff as each other, all the names that are in the media at the current moment in time, and a lot of the positions that they have on, are generally affected by the same things in the market. So they're not actually diverse. Okay. So retail traders end up with very concentrated risk, and professional traders end up with diversity, genuine real diversity, and risk management broken down into preemptive and reactive risk management. Now, what about the returns that professional traders go for? Okay. What are professional traders actually looking to get in terms of returns? Well, there's a variation, obviously, there's a spectrum, but overall, what professional traders are trying to do is get long-term consistency in their returns. Now, that can be a situation where they try to make 15% every year. It can be a situation where they try to make 25% every year. What it comes down to with professional traders is the level of risk that they're taking and the return that they get from that risk. Okay. So, for example, like we looked earlier in the hedge fund example, where we mentioned as an example a hedge fund that gets a 20% return out of a 14% risk portfolio. Now, let's not concentrate on the details here of how that risk is measured, but let's just take it for granted that 14% risk is taken in a portfolio and a manager achieves 20% by taking 14% risk. Well, there is a metric in the professional trading world called a Sharpe ratio, SHARPE, Sharpe ratio. That is basically your return over the risk you take. So for every unit of risk that you take, what return do you get? In that example, it would be around 1.43. Okay. For a retail trader, that would be a phenomenal result. Why? Well, first of all, the vast majority of retail traders just don't even make money. Okay, so just to have a positive number is good. Even if it was above zero, that means the retail trader is making money. Okay, the Sharpe ratio is between, say, 0 and 1. But professional traders always aim to get a Sharpe ratio that's above 1. And retail traders, if they were to get a Sharpe ratio of 1.43, that's amazing. Okay. Generally speaking, a good Sharpe ratio for a professional trader over the long term, over thousands of trades, would be between 1.8 and 2.2. For a retail trader, just to make money is the first step. Okay. Then a return out of the risk that they're taking, that's higher. That's the next stage. Okay. But what do retail traders typically do now? If we just, opened 100 random retail trading accounts, what are they typically doing in terms of the return that they're going for? Okay. Well, we've looked at the approach, we've looked at the risk. These things tend to go hand in hand. Okay. Typically, when we open those trading accounts, what we're going to see is very, very short-term positioning, very concentrated, and they're going for YOLO, or you only live once, outcomes, YOLO outcomes in terms of return. And it can go either very, very right or very, very wrong. So binary, very right or very wrong, very quickly. Okay. That's a typical situation with a retail trader, unfortunately. Vast majority blow up, lose their money, and this is why. On the other side of the spectrum is the professional traders. Professional traders just don't even think about getting involved in stuff like that. Okay. The return that a professional trader is going for is so different and so against the perception of what retail traders think. Hedge fund managers and old school investment bank prop traders are going for long-term consistency on a risk adjusted basis. And when we put this together, when we look at approach, risk and return, and compare professional traders to retail traders, when we put it together, what's the outcome? Well, think about it. If you're a retail trader and all you ever do is trade really short term or within a day, you have very concentrated risk and you take, it's either going to be in the money or out the money very quickly. And it's a you only live once, YOLO, lottery ticket type position. What's going to happen to you over a number of trades? It's not going to be good, okay? What ends up happening is capital destruction. Your money goes to zero, and then people save up some more money so they can try again next year. And they're on the hamster wheel. Essentially, again, we're back to the competency hierarchy and unconscious incompetence. They're just going round and round in circles, learning the same nonsense, making the same errors, and doing it over and over and over again. Okay? That's the retail trader, unfortunately. On the other side, professional traders. Again, we're talking about the hedge fund manager and the investment bank prop trader pre-Volcker rule. Okay? What's the outcome there? Well, initially, it's always capital preservation after growth. What are they trying to do? They're trying to grow their fund consistently over time, grow their account consistently over time. Their incentive is to collect higher fees and bigger bonuses. So they want to grow that number as much as possible. This obviously differs greatly from retail traders. Now, there are obviously more differences. What about the question that we posed earlier when it comes to trading for income? What about the outlook for growth? How do they add or take away money from their accounts? What results should we expect in the differences and outcome again? Well, let's take a look. So for the professional trader, we've mentioned it a few times in this video. Both hedge fund managers and investment bank prop traders pre-Volcker are paid basic salaries through commission and management fees. Okay. Retail traders aren't. Okay. They work full-time or part-time, and their intention when they go into the market is to trade for extra income. Okay. In later videos, in this video series, we're literally going to prove to you in numbers that trading for income is not possible. Let's just here right now assume that it isn't. Okay. One of the things that you should take on board here is that professional traders pay themselves basic salaries and they set up the infrastructure so they can get a basic salary from management fees and commission for a reason. They do that for a reason. Why? Because they know trading for income over many trades over a long period of time is impossible. Because they know they're going to have months when they're down, and they might have long periods of losing streaks, and taking an income from the account during that time period from losing streaks is going to be a bad situation, because the level of their fund cannot grow. The level of their account cannot grow if they keep doing that. So think about it. If they make money, they pay themselves an income. If money goes down, if the fund goes down in value, they pay themselves an income. If in that situation there's a losing streak for a while, what do you think happens? It can only go to zero. Okay. This is what the retail trader does all the time. Okay. This is now growth. How to grow an account. What does a hedge fund manager or professional trader do? Old investment bank style in the prop account. Well, in the prop account, the manager would just increase the size of the account. The hedge fund manager increases it by default because of their contract with investors. Okay. So what happens? They add to their account when they're winning, and they don't add when they're losing. So their risk is going up when they're winning, and then their risk stays the same or reduces when they're losing. If they're losing value, so they're actually reducing risk without doing anything, right? So if that $1 billion fund became a $950 million fund, that is a reduction in risk, obviously, because they've gone from $1 billion to 950. Okay, so they add to their account when they're winning, and they don't add when they're losing. That's because they have basic salaries. They can do that. Okay, they set up the infrastructure, so it's set up to enable that situation. What do retail traders do when they go into the financial markets and start trading for the first time? They go out to trade for income. So if you think about it, if a guy's going into the market with, say, 25 grand in his trading account, and he's got $2,000 of expenses that he wants to pay for every month, okay? If he has a good month and makes a few $1,000s, he takes the money out. If he has a bad month and loses a few $1,000s, he takes the money out. So he goes down 4,000. If he keeps doing that, there's only one thing that can happen. The account goes to zero. It's just a question of time. So what's the result here? Well, for the professional trader, hedge fund manager, professional trader, assets under management grow through reinvestment and an increase in outside investment. If they're performing, they're going to enable raising more money. More people, more institutions will be interested in investing more money in their strategies, so they grow consistently, predictably, okay? Retail traders, what happens if they take this approach? So they go into the market, try to trade for income, take money out every month, whether they're winning or losing. They rely on their trading account for an income to pay their bills, to make their car payments, to make their rent, to make their healthcare payments. What happens to their account? Boom, trading account goes to zero, and it can never grow. Capital destruction, assets go to zero, try again. Hamster wheel, unconscious incompetence. What happens to the hedge fund manager, IB, professional trader, pre-Volcker? Capital preservation, predictable growth. Hedge fund manager, for example, would potentially sell their fund. Essentially, they're growing and they're charging higher fees and paying themselves bigger bonuses. So obviously, guys, massive differences, huge differences in the way retail traders go into the market, approach the market with risk and return, what their outlook is in terms of how they pay themselves and how they grow their business. In fact, retail traders don't even realize it's a business, okay? They don't even realize what a trading account is actually for, okay? Again, back to the level of unconscious incompetence. Internalize these messages and you will get higher in the competency hierarchy just by knowing this stuff and putting some of these things into action. So let's try to put a few of these things together. Differences between pro traders and retail traders. Let's start with expectations, okay? All professional traders, their expectation and their aim is to get rich slowly. Now compare that to the typical expectation of a retail trader. What's the typical expectation of a retail trader? Their expectation is that they're going to go into the market and turn $500 into $1 million within a few years. Okay. It's obviously wildly extreme and ridiculous. Okay. No professional trader would ever think that. Why? Because they understand financial markets. They understand risk. Okay. They understand that it's not even possible. Right. So retail traders have wildly unrealistic expectations. Okay. So a big difference between pro traders and retail traders is just their own management of their own expectations. Okay. But this all comes from education and understanding financial markets. Okay. Next up, compound returns. What are professional traders aiming for? Consistent risk-adjusted returns, compounded over many, many years. If they do that, they're going to become very rich over time. if they're steady players with a solid track record as well, outside investors are going to invest in them. So this becomes a compounding effect, which increases wealth over time in their career. Obviously, retail traders don't think like this, okay? Most retail traders, when they open a trading account, aren't even around after the year is over. The vast majority are not even around after year one. Then they open another trading account and try again. 97% will not be around after 2 years, okay? Because they're taking the approach that we've shown you on previous slides. They're not looking at this as a career, compound returns, get rich slowly over time, acquire a solid track record, a track record that investors would invest in them if they really genuinely wanted to turn it into a career. They're not looking at it in that way, okay? But it's essential, if you're going to succeed in this, that you start looking at it in that way. Because if you don't, you're never going to do well in trading. You just won't. It's an unfortunate truth of financial markets that you've got to start looking at this as a much longer term endeavor. It's not about just the next trade. It's about the next 100, 200, 500, 1,000 trades. You've got to look at this as a process and a long-term endeavor. Next up, income in trading. What about income from trading? Well, all professional traders know that basic salaries are required. They know that there's no such thing as income from trading. Trading, by default, by definition, is not an income strategy because you're taking risk. It's not guaranteed. We're not investing here in sovereign bonds that pay a coupon, okay? We're actually taking risk in financial markets. Of course, we can choose what level of risk we take, which is something we're going to discuss much later. But this is not guaranteed income, okay? Trading by default, by definition, is not an income strategy. Therefore, you cannot rely on it for an income. It's very obvious, okay? So anyone that tells you that you can make an income from simply trading is unfortunately lying to you, okay? They're lying. And anyone that tells you that you can make an income and make a certain amount in a certain time period is also lying. Why? Because the risk that we're taking is totally dependent on the volatility of the asset. And you do not determine that. Something called the market determines that. Therefore, you cannot transpose a requirement of an income onto the market. So if you go into the market and say, I want to make X amount, let's say $10,000 in a month from trading the stock market or day trading stocks, okay? What if stocks don't move for 3 months or 6 months? You can't transpose your requirement for a number onto the market. The market tells you what is possible, not the other way around, okay? So this idea of trading for income, it works on two levels. Firstly, trading for income doesn't work because if you rely on it for an income, you will be taking money out of your account every month. So when your account is up, you take money out. When your account is down, you take money out. That means your down months are much bigger than your up months, as a general rule over many trades over a long period of time. That means your account goes to zero. Additionally, on the second level, you can take out a certain amount of money per month. It's not possible because the assets that you're trading may not move for a long period of time, the amount that you require them to move to get the income that you want. Okay? So it works on two levels. Income for trading doesn't exist. It's a lie. It's a myth. People who are telling you that are lying to you. Okay? Every professional trader knows it, and that's why they have basic salaries in the infrastructure that they create. But they get their performance, their bonuses from the performance that they get for their shareholders or their investors. Okay. The way you've got to start seeing a trading account is that a trading account is not really a P&L. You've got to see it as a balance sheet asset. A trading account is an asset in itself. It sits on your balance sheet as a human being, and you have to seek to grow the value of that asset. Kind of treat it like, everyone understands a property example, where you have a property and there's a net worth of that property if you've got some debt on it. Let's say it's a $500,000 property. You've got $200,000 of debt left outstanding, mortgage payments to make. Like the net worth of that property is 300,000. Okay. That's an asset. That's a net asset. It sits on your balance sheet and can be added, and it's a net positive. Okay. A trading account is the same. A trading account should sit as an asset in itself on your balance sheet as a human being. Just add it to the asset column of your balance sheet, and you have to grow it over time. Get compound returns. Forget about income from trading. Build the asset that is your trading account. And just to make sure it's really highlighted, all professional traders know that they have to have an income that's additional to the trading account to cover their basic costs of living, to pay for them to live. A pro never takes money out of their trading account because they're looking to grow it over time. Okay. If you have an income on the side, you can leave your account alone and grow it as a balance sheet asset over time. And if you compound those returns, you get good returns and compound them. That's called wealth creation. You're building wealth. You're building assets. Okay. Problem is, retail traders believe the opposite, which we've highlighted now, that trading is essentially for income. And we're going to get onto some other differences later in terms of time horizon. If you're somebody who's sitting there in front of your screen now, thinking, well, I don't trade for income. I have lots of positions and I do okay. Well, the probability is that you're not actually trading. The probability is that you're most likely an investor. And there's a big difference in the time horizon between what we define as traders and what we define as investors. Here, we're always referring to traders in either the 1 to 3 month time horizon as professionals and comparing that to what retail traders do. What we're not comparing the 1 to 3 month professional trader to is a retail investor. That's very different. So if you have a pension and you've got 15 positions in it and you've had those positions on for an average of 2 years, we're not making that comparison. Okay. We're making the comparison to retail traders and what retail traders do in trading accounts, not retirement accounts or investing accounts. Okay. When it comes to income source, all professional traders know that they have to have an income outside of their trading account. Retail traders literally trade for income, or they attempt to, they try to. Okay. You should really take these messages as important messages and internalize them. That's really going to help you get up the hierarchy. So, quick recap: expectations management. Got to manage those expectations, guys. You're not going to become super wealthy very quickly. Financial markets don't work like that. Yes, you will have the occasional fleeting success, but over time, the more you do it, the more probability you're going to have of blowing up. Compound returns. Pro traders compound their returns. They understand the risk that they're taking. They understand the return that they're going for. Retail traders typically don't. It's all you only live once. let's go for it, lottery ticket purchases. Income from trading and income source. Pro traders know that there's no such thing as income from trading, which is why they literally create the infrastructure so they can take basic salaries. Retail traders genuinely believe that income in trading is real because they get told by people that don't have their best interests at heart. And they genuinely believe that it's real, and they end up taking ridiculous amounts of risk that's very concentrated in binary outcomes on a number of occasions over a short period of time to try and get this elusive outcome that's called income. Doesn't exist. You're just going to blow up. Professional traders do this do things the way they do things for a very, very good reason, because all the things that retail traders do don't work, and pro traders know they don't work. The stuff that you've seen here is going to help you start climbing up the competency hierarchy to the next level. Of course, you've got a long way to go, but that's what we're here for. Now, in the Institute, we mentioned this earlier, but in the Institute traders, guys who have been through our programs and are trading with real money, those guys tend to be hovering just beneath professional trader status. So they're basically on average between conscious competence and unconscious competence. The difference between the guys that are unconscious competent and conscious competent is generally the length of time that they've been doing it, the amount of trades that they've done, the experience that they've gained, the outcome of gaining the experience means that it becomes second nature. So getting the education, every one of those guys that comes through becomes at least competent. But then obviously you have to implement it and do it for a good period of time. Most retail traders, vast majority, will be stuck on level 1 without the right information, and then implementing that information. They're just going to be stuck there. The fact that you're here means that you're probably not going to be if you start going through our programs. This is just one program. If you start doing our programs and implementing our strategies, you will climb the competency hierarchy. What's the challenge here? The challenge for retail traders is not just to become profitable for 6 months, okay? It's not to just be profitable for the next year. It's to be consistently profitable forever. Try to be consistently possible for the rest of your life, okay? That's what competency is in trading. There's a big misperception in the retail trading world of what competency in trading looks like. Competency in trading doesn't look like take a position once a month or once every few months because you heard it might be a good idea, and then you make some money out of it, or you don't. And then over time, you manage to beat up for whatever reason. That's totally random, okay? Consistency in trading comes from having a process that is repeatable and sustainable. That's where you get consistent profitability from. Where do we start if you're a retail trader and you're at the bottom of the hierarchy? Well, you've got to drop your old ideas, okay? You can't even begin to climb the pyramid in trading unless you recognize that your old ideas don't work. Yes, you can always point. We see this a lot. Guys come to us and they say, I need your help. And they point to some of their successes in the past and they think it means something. It doesn't. A lot of people have had some fleeting successes where they get, one big trade right and then they get 9 wrong. People do experience fleeting successes. But overall, if you take the approach of a retail trader, over many trades, over a long period of time, you're just going to blow up. You're going to lose money. You're taking an approach that's not sustainable. It's not going to provide consistent profitability. So as in the professional approach. What happens when you jump up to conscious incompetence? Well, you know you're doing it wrong. You drop your old ideas and you start to learn the pro trader processes. Okay. Sustainability in trading means consistent returns. It can only be achieved through a robust and repeatable systematic process. You've got to learn the theory of how pro traders do it, how they select their trade ideas, how they time their trades, how they structure their trades, how they build portfolios, and how they manage risk both preemptively and reactively. Okay. That's a lot of work. But no one said this is going to be easy. It's a lot of work to get from conscious incompetence to actually become consciously competent, to get into competency. Okay. Because then you've got to take the step of actually implementing it profitably. If you implement it and you don't make money, you can't claim to be competent. Okay. You can claim to know the right information for sure. Of course. But turning that information into real money, into real hard dollars is what it's all about. Okay. So you got a long way to go. Now, to implement profitably, you've got to absolutely properly commit to the process that you've learned, implement it in a live trading account with real money. Demo accounts don't count. You've got to achieve good, positive, reasonable returns over a number of trades over a period of time. It can take a year. Okay. Now, if you have difficulty in bridging that gap between the theory and implementation, you've got to get mentoring. On top of that, you've got to actually fit this into your real life. Okay. That's a challenge. We teach processes for retail traders, professional trader processes that are designed so people can fit them into their lives. 10 to 15 hours a week commitment. Okay. There's no doubt about it. You have to show up every week. You can't show up once every 3 months and put a few positions on. That's one of the big challenges for retail traders. You've got to have a minimum weekly commitment and a maximum weekly commitment. If you're prepared to do that, you can really learn how to do this very, very quickly, 3 to 6 months. And then once it's fit into your life, it becomes much easier. When it becomes easier and you're on autopilot mode and making money, what happens? You can start claiming that you're unconsciously competent. You're on autopilot mode. You're managing your trading account. You get account growth on a consistent basis, and your weekly processes become very natural. You're generating high quality ideas on a weekly basis, and you know how to build and manage your portfolio successfully. You're relaxed because you've now got experience. You take all outcomes that occur in your portfolio in your stride. What is actually happening here is that you're basically professional standard, but you're existing as a retail trader within the retail trading infrastructure. That's what we're aiming to do here, guys. Get you up the hierarchy. And what does that mean? It means consistent profitability and a lot of experience. Now, do you remember our objectives from the beginning of the video? Let's recap. Well, we are providing a framework that allows you to emulate consistently profitable traders, so you can benefit from the same approach, but obviously in the retail trading infrastructure. We're aiming to make you consistently profitable by providing the framework, but the framework has to allow retail traders to utilize the pro trader approaches in their own retail brokerage accounts in the retail trading infrastructure. The framework also has to allow retail traders to implement the processes realistically on a weekly basis so they can fit the endeavor of trading into their normal everyday lives. Okay? But to even just start this journey, guys, your first step, once you've admitted to yourself the wrongs that are out there in the world of trading, the things that you've done in the past, perhaps there'll be a lot of people that have, watching this who have traded as a retail trader and just had consistent losses over a long period of time. There'll be people watching that have never traded at all, but can see what's going on in the world and see it for what it is. Your first step, once you've admitted that, is to learn the theory. The good news is you're here already, which means you're on your way. As an organization, ITPM, we can take you all the way. If you really want to go further, PTM, Professional Trading Masterclass video series, the POTM, the Professional Options Trading Masterclass, and the PFTM, the Professional Forex Trading Masterclass. It's a lot of work, but to get up that competency hierarchy, to get into the level of competency, these are the programs that you have to do. Okay, IPLT is just an introduction. The clue is in the title, Introduction to Professional Level Trading. However, even when you take all of these things together, it's the theory, guys. We're showing you the educational information and the theory of how it works. Okay, you've then got to apply it. Okay, we can only get you to the door of conscious competence. Okay, you have to step over the line yourself. You have to actually go and implement it, and you have to be self-sustainable. You can't be a trader and make money consistently over time by doing our programs or anyone's programs in the world, and then after that rely on other people for your trade ideas. You have to walk through the door and do it yourself. And if in the future you do all of this and you have a problem becoming consistently profitable over time for whatever reason, the best way to deal with it is to get a trader mentoring program with one of the ITPM professional traders, where they give you a boost and shortcut you into high levels of competency. So what's next? Complete the Introduction to Professional Level Trading, the IPLT video series, and learn how professional traders approach the markets, so you can just begin to climb the competency hierarchy. After that, take the PTM video series. That's where you're going to learn the pro trader processes for trade idea generation, timing, trade structuring, portfolio building, preemptive and reactive risk management, plus trader metrics and track record management. If you take the POTM as well, the reason why you take that is to specifically learn and go deeper into options structuring of your ideas, your trade ideas, so you can get better return on investment, ROI, on your ideas, out of your portfolio, and also to structure things in a way where you get asymmetric risk reward. Next up, PFTM. This is something you can do much later if you want to. It's a skill set that you can add in terms of trading Forex later down the line. The opportunity set, the amount of opportunities that are available generally in the Forex market versus stocks, which is basically the PTM 2.0 and POTM. The opportunity set is way smaller in the Forex world versus stocks. That means the PFTM can be done much later down the line if you want to do that. Once you become competent trading the most volatile asset class, which is stocks. We're going to show you that in this video series. If you really want to get up the curve quickly, you can obviously consider a mentoring program with one of the ITPM professional trading mentors. If you do that, it's crammed in. You get all of the programs included. So you get the PTM, the POTM, and the PFTM. Before you start your program, you definitely need to complete the PTM and the POTM. PFTM is not necessary to begin with, but essentially you book it up front. You get the video programs done. You understand what's going on. You open your trading account. You deposit your money. Then you jump on the phone with the mentor for 12 weeks. So if you want to consider a mentoring program, that's how it's done. Or you can just take the online programs in your own time and then upgrade to a mentoring program later. But right now, we are in the IPLT, the Introduction to Professional Level Trading. We're going to start looking now about in terms of dropping your old ideas, how you can go about that. It's all to do with understanding, guys. You've got to start understanding financial markets properly. If you can understand the content that we're going to be presenting to you now in the IPLT, if you understand that, your old ideas are just going to start to melt away. So first, let's start with working on all of your old ideas, and let's extinguish the unnecessary pain of unconscious incompetence. Then, and only then, can we move on to how real professional traders approach the markets. And that's what we call, ladies and gentlemen, volatility. So guys, I'll see you in video number 2. Let's go over to the next video.